Joining me now, Sam Stovall, Chief Investment Strategist at CFRA. Sam, always good to have you. Thanks so much for being here.
Happy to be here, Caroline.
Sam, I know you love an old adage, so let's start with as goes January, so goes the year. Is that going to be the case, do you think? And how would you describe January so far, Sam?
Hello, Caroline. Well, yeah, the Stock Traders Almanac was the one that popularized that phrase, basically indicating that if we have a positive performance for the S&P 500 in the month of January, for the full year, we tend to see an average increase of a little more than 16%. With the market rising 86% of the time as compared with 72% for all years. So far, we've had a positive first 5 trading days of January, which is sort of an early warning signal for the market. And so right now, things do look as if they are fairly healthy as we head into, this new year. Energy, industrials, materials being on top, with some of the high flyers from last year, financials, information technology, and utilities, coming in last.
Yeah, we've also been seeing this rotation into small caps, because if you take a look, the Dow is outperforming the NASDAQ and the S&P, but the Russell is outperforming all three of those. Do you think that that's kind of a rotation that we should expect to continue?
Yes, you're absolutely right. Small caps have outperformed mid caps, and mid caps have outperformed large caps. I think it's a continuation that investors believe that the Fed will continue to cut rates in 2026. And historically, in the second year of a rate easing cycle, the small and mid caps tend to do well, but the market itself also ends up being fairly strong. Also, what we're seeing is finally the mid and small caps catching a break, because they're currently trading at a 27% relative PE discount on the mid caps over the past 20 years, and a more than 30% discount for the small caps. So basically, grossly undervalued when compared with the average 20-year relative PE. So I would tend to say that investors, it's a good thing that they are rotating rather than retreating. So they're taking some profits in some previous high flyers, at least early on in this year, and gravitating more toward mid, small, and value.
You mentioned some of the outperforming sectors so far in January. Granted, we're only, 15 days in, but materials, industrials, energy, staples, real estate, all outperforming things like tech. As we think about valuations, though, what areas of the market still look cheap?
Well, when you look specifically in areas, none of the sectors except for energy is trading below its longer term average PE ratio. All of the other sectors are trading at premiums to their 10 and 20-year averages, and most are even trading above their 5-year average. On a relative basis, however, energy is the most attractive at a 26% relative PE discount to the S&P 500 over the last 20 years. We're also looking at utilities trading at a 19% discount, and financials, which have been beaten up as of late, are trading at a 14% discount. So we're continuing to believe that for the full year, that we will see the high flyers from last year, communication services, industrials, financials, and tech, be outperformers overall in 2026.
Okay, so that being said, where do you see the S&P 500 by year end? What's your price target?
My price target is 7,400. As you know, I sort of start with history and then overlay macro earnings, etc. And essentially, history says in midterm election years, don't expect a very strong return. On average, since World War II, the gain has been only 3.8%. And the market has risen only 55% of the time, so really no better than a coin toss. And those numbers are fairly consistent if you even just go back to 1990, and realizing that we just scored a three-peat, meaning 3 successive calendar years of double-digit gains. Only 3 times since World War II did we end up with a four-peat, so a very rare situation.
Okay, so I was just trying to do some quick iPhone math. It looks like, what, 6% upside from here? What gets it there?
Well, what it gets us there is the continued optimism that we are going to be seeing an improvement in corporate profits. In 2025, estimates are that we will have seen an 11% gain in earnings. But what's interesting is that Q3, when we first started that earnings reporting period, expectations were for about a 7% year on year rise, but we ended up with more than 15%. So we then had the 64th quarter out of the last 66 in which actual results exceeded end of quarter estimates. And I believe that investors are anticipating a similar level of outperformance in 2026 and 27 because estimates right now are for a 14% gain in this calendar year and a 15% advance in 2027, with those numbers likely to be edged higher.
What's the biggest risk to the market right now?
Well, you always have the possibility of a pullback or a correction. Those are declines of 5 to 10% for pullbacks, 10 to 20% for corrections. I like to say that bull markets don't die of old age, they die from fright. And what they are most afraid of is recession. We had that scare earlier in 2025 because of tariffs and the fear that we could be thrown into a US or a global recession. But now I think that we probably are going to see a lot of hiccups, a lot of market volatility, because again, it's the midterm election year. The only two successive quarters of average declines are in the second and third quarters of midterm election years. It has the deepest average annual drawdown, so the intra-year decline averaging 18% for midterm election years is the steepest of any of the 4 years of the presidential cycle, especially when you have a wave situation in Washington, meaning that the president and both houses of Congress are of the same party. Because on average, the Senate tends to lose 4 seats, and the majority in the House tends to lose 33 seats. So that could end up throwing the majority of both houses back to the Democrats if those averages were to be maintained.
Well, on that note, Sam, President Trump is coming up on the 1 year mark of his second term. How is the stock market doing under this administration compared to previous ones?
Actually, pretty well. So the official end is not until this coming Tuesday, so we got to give him a couple more days. But right now, through last night, the S&P 500 was up 16.2% since inauguration day of last year. And so therefore, his first year in office ranks him ninth out of the 21 presidents since FDR and Truman were reelected in 1944. So you could say, however, well, what about his performance versus other Republicans? Well, interestingly enough, the first year in office for all Republicans, and there were 11 since World War II, their average gain was only 1.5%. So the market has done exceptionally well under Trump's first year in office. And if you say, well, what about presidents in their second term in office? Here, the president is still doing better. The 16.2% compares quite favorably to the average 12.3% for the first year of second terms. So no matter which way you slice or dice it, with or without a Ginzu steak knife, you end up with a pretty impressive return.
Who's at number one, though, if he's at number 9?
Well, number one is FDR and Truman in 1945, 46 actually, but you could probably give the end of World War II the credit for that. So if you wanted to say, well, what about a non-post-World War II year? Obama in 2010 had a gain of 34%, so that ranks number 2. The best performing Republican was Trump himself at 24% in 2016, which ranks number 4 out of all 21 presidents.
Okay, Sam, just wrapping up, we kind of started with the good omen of the first 5 days of January being positive. That could be a good omen for the year. I'm curious if the record highs that we've been seeing in things like gold and silver and copper, and I think tin as well, could that be a bad omen for this rally, that there's so much money going into those safe havens as well?
Well, I believe that money has been going into the safe havens, obviously, because of the uncertainty that has been surrounding the markets in terms of the tariff tiffs that have occurred over the last year, looking at valuations, et cetera. I think that 2026 will end up being a good year, but not a great year. My target is 7,400 by the end of the year for the S&P 500. Valuations are a bit pricey, but it all depends on whether you look at a 20-year average or only a 5-year average, which is as far as AI really has been pushing the tech side of the equation. So, in general, I think that we should buckle up for a lot of volatility, but in the end, things will be positive overall.
We'll leave it there. Sam Stovall, Chief Investment Strategist, CFRA. Thanks so much.
My pleasure. Good to talk to you, Caroline.